Business meals are one of the most audited deduction categories in small business tax returns. Not because the deduction is illegitimate, it is perfectly legal, but because it is one of the easiest to fabricate and one of the hardest to substantiate correctly after the fact. The IRS has specific documentation requirements that most business owners learn about only during an audit. If you cannot answer 5 specific questions about every business meal receipt in your records, the deduction will be disallowed. All of it, not prorated, all of it. The current rule under the Tax Cuts and Jobs Act of 2017, business meals are 50% deductible. The temporary 100% restaurant meal deduction enacted for 2021 and 2022 expired December 31, 2022. As of 2023 and beyond, the deduction is firmly at 50%. Entertainment costs, tickets to sporting events, concerts, theater are entirely non-deductible since TCJA, even if conducted with a client. A client dinner is 50% deductible. Client seats at a game are 0% deductible. The distinction between meals and entertainment is where most business owners make their first error. A qualifying business meal requires 3 elements under IRC, Section 2004. First, the expense must be ordinary and necessary in carrying out your trade or business. Second, the taxpayer or an employee must be present at the meal. You cannot deduct a meal you sent to a client without attending it. That becomes a gift, subject to the $25 per person annual gift deduction limit. Third, the meal must not be lavish or extravagant under the circumstances. The IRS does not define a specific dollar ceiling for lavish. It is contextual, but a $600 dinner for 2 in a rural market on a $40,000 revenue business draws scrutiny. The IRS's substantiation requirements for meals come from IRC, Section 274.7. For every meal deduction, your records must show 5 elements: the amount of the expense, the date of the meal, the location or name of the restaurant, the business purpose of the meal, specifically what business was discussed, and the business relationship of the people present. A credit card statement showing a restaurant charge is not sufficient documentation. It shows the amount and date. It does not show purpose or attendees. You need both the receipt and a contemporaneous note capturing the other 3 elements. Contemporaneous means recorded at or near the time of the expense, not reconstructed months later from memory when your accountant asks for substantiation. A note in your phone, a quick entry in a meal log app, or a notation on the back of the receipt all qualify. A spreadsheet you complete in April covering 12 months of meals does not. The IRS can challenge the credibility of backdated records. Contemporaneous documentation is one of the most defensible positions in an audit. Reconstructed documentation is one of the weakest. Meals while traveling for business are subject to the same 50% limit and the same substantiation rules. But solo travel meals, a meal you eat alone while away from your tax home overnight for business, are deductible. You do not need to be entertaining a client or discussing business over the meal. The business travel itself is the qualifying activity. A solo lunch in a hotel restaurant while at a conference, deductible at 50%. A solo lunch at your regular office when you work from home and never left your tax home, not deductible. The IRS audit trigger patterns for meals are well documented. Red flags include meals deductions that are disproportionately large relative to total revenue, meals claimed every single day of the week including weekends and holidays, Meals claimed at the same restaurant repeatedly with no variation in amount, and 100% of meals deducted without any personal meal allocation, since most people eat at least some personal meals that are not business-related. A deduction that patterns like a personal expense schedule, not a business one, attracts algorithmic scrutiny before a human examiner ever sees your return. Office snacks and meals provided to employees on your business premises for the employer's convenience under specific conditions were 100% deductible prior to 2018 and are now 50% deductible through 2025, after which they become non-deductible under the current law. If you are paying for a shared team lunch in your office, document it as an employee meal, not a client entertainment expense. The category determines the form it is reported on and the substantiation standard. The IRS applies. Employee meals on premises have a different evidentiary standard than client meals at restaurants. A practical system that survives audit uses a business credit card for all meal expenses. After each meal, photograph the receipt which shows the itemized total, not just the card charge, and immediately record the attendees and business purpose in a Notes app or expense app linked to that transaction. At year-end, export a transaction report from the card, cross-reference it to your photo log, and your documentation is complete. 2 minutes of effort per meal creates a defensible record. Most IRS meal audits fail, not because the meal was illegitimate, but because the documentation is absent. The business meal deduction is real, it is 50%, and it is available to every self-employed person who eats with clients, prospects, and business associates in the course of running their business. What kills it is insufficient documentation. 5 data points per meal recorded contemporaneously on every receipt. That is the standard. Meet it and the deduction is clean. Ignore it and even a legitimate deduction becomes indefensible in an audit. If you want to understand what the IRS audit process actually looks like from the inside, our video on what happens when the IRS audits you covers the exact process, step by step. Meal deductions are clean when documented and dangerous when not. If you want to see exactly what the IRS does once a thin deduction draws attention, what happens when the IRS audits you walks through the actual process step by step, it is on this channel.